Today's workshop is about buying a home, financing your home purchase or mortgages. How it works is, let's see if you want to buy a house. The first thing you want to do is speak with a lender and address any credit issues and get a pre-approval. Once you get your pre-approval, the next step is going to be home shopping. Basically, discuss your criteria with buyer's agent, tour, listing. Basically, tell the agent what kind of a house do you need, what do you want to buy. And once you do that, you're gonna offer and make negotiation. And then after you do that, there's something called due diligence. Due diligence, basically, you're gonna do the home inspection, the appraisal, the survey, negotiate repairs. If there's any damages needs to be repaired, you're gonna negotiate that with the mortgage company, and then begin title exam, and then finish the loan. After that, that is the last steps called pre-closing and title. Pre-closing and title is basically confirming the repairs are completed. Pre-closing walkthrough, you can just see the house, see everything is done what you asked for, and then sending funds to the closing attorney. Basically, you're paying the lawyer or the closing attorney. And then once you do that, that's where you get the keys and you pay the closing cost and you move into your house. What is a mortgage? Mortgage is basically a loan for your house that you're gonna promise to repay the loan. And to get a mortgage from a mortgage lender, usually the mortgage is for 15 months, 15 years, 20 years, and 30 years. Majority of the people, about 90, 95 or 80% of the population, they go with a 30-year mortgage. What do I need to get qualified for a home mortgage? Okay, that's a very, well, what do I need to buy a house? What are the qualifications for me to buy a house? Well, the qualification, one of the major and one of the important of the qualification is you have to work at least 2 years in the same company. In other words, 2 years of work history from a job in the same line of work. So let's say if you're working, just making a company, I don't know, if you work for an Apple as a management team, you have to work at least 2 years for Apple company. It's just an example that I'm giving you. You have to have at least 580 plus. Hey, listen, 580 is not the greatest score, credit score. Your aim should be above 640 or at least 680. But the minimum credit score that you can have is 580. Number 3, which is the other important thing, is savings for down payment of the house. And then enough income based on a home purchase. So you have to make your financial plan. And then the last thing that you want to do is debt to income ratio. Basically, whatever your monthly debt is, your credit card, your car loan, your anything, you would add all of them and you would divide it by your monthly income and then multiply it by 100. See what percentage does it fall into. There are types of mortgages as well that we can think of. Fixed rate mortgage. What is a fixed rate mortgage? Well, fixed rate mortgage is the interest rate that stays the same over the entire term, usually 15, 20, or 30 years. That is a good thing about it. And the bad thing about it is if the interest rate falls, if the interest rate goes down, you could be stuck paying with a higher interest. For example, let's say that you have a 30-year fixed rate at 5%. Over the year, the interest rate falls down to 4%. Well, bad thing is that whatever your mortgage is, you'll be paying your mortgage with a 5%, even though the interest came down to 4%. That is the bad thing about it. Adjustable rate, known as ARM, or variable rate mortgage, also usually offers a lower initial rate of interest that is fixed rate loans. Basically, it's something that you would be you would pay mortgage with the lower interest rate. That is a good thing about it. But now here's what is bad thing about it also. Everything has a pros and cons. After the initial period, rate fluctuates over life of the loan. When the interest rates rise, generally, so does your loan. So for example, let's say if you have an adjustable rate, and then if the rate goes up, like let's say your current rate that you're gonna have is 3%. Now, when the market goes down and your interest goes up, then your interest is gonna go up, and then your monthly mortgage payment will go up as well. There's something called FHA, Federal Housing Administration loan, that is done by the government. It allows buyers who may not qualify for a home loan to obtain a low down payment. It is a good thing. That is what is beautiful about it. And then it's also the bad thing about this, which is the cons, is basically the size of your loan may be limited. For example, let's say that it allows a home may not be qualified for a home loan to obtain. So basically, like let's say you have a less income and then you don't have much money saved out. You can apply for Federal Housing Administration, but there's a limited amount that you can apply for. Let's say you can apply for only, I don't know, like $300,000. That is the only bad thing about it. And then also there's a VA loans. VA loans, it's not a Virginia loan, it is veterans loan. Basically, whoever served in the US military. Basically, it's a guaranteed loan for eligibility if you're a veteran. And then you have to be active duty personnel and surviving spouse, or competitive rates, low or down. That is a good thing about it. And then the only thing is also same thing as the previous one. It's very limited amount of dollars that you can ask for. What is the difference between a fixed rate and the adjustable rate? Well, fixed rate is basically is the set rate of an interest that goes that does not change throughout the life of the loan. And then it also typically makes it easier for homeowners to budget. And then also it provides protection for a sudden changes in the mortgage rate. And also difficult to, and it's also actually, it is very difficult to get qualified if the interest rate are high. And the adjustable rate is basically rates that sets rates set below the market rate on the comparable fixed rate loan that rises, if possible, lower over time. So basically, if you have a rate, let's say if you have a adjustable mortgage rate at 3%, and then after 3 years or 4 years or 6 years or 8 years or 10 years, the interest rate is going to go up to 8%. Guess what? Since you have an adjustable rate, your mortgage, your interest is going to go up 8%. And then also typically much cheaper than fixed rate mortgage, at least in first 3 to 7 years. So first 3 to 7 years, you're going to pay with a, it's going to be very cheaper for you. But after that, there is a little bit expensive to go up. And then also the monthly payment can be changed frequently, making it difficult to budget. So for example, let's say 1 month you're going to pay 3,200, next month you're going to pay 3,500. So it kind of like makes it difficult for us to plan our budget accordingly. Principal plus the interest. So what does that mean? The principal basically is the amount of money left to pay off the loan. And then the interest is the money that you have to pay just to have the loan. Basically, it's 10 to 12 years, the monthly payment. Basically, when you buy a house, the first 10 to 13 years, when you make a payment, you'll be covering. Excuse me. Then when you have a mortgage, the first 10 to 13 years, the monthly payment converts from being called mostly interest to the principal. So for the first 10 to 13 years of the mortgage, you'll be paying mostly only the interest. And then also, then after, excuse me, after 20 to 23 years, then you'll be paying the most payment for your down payment will go towards the down payment, towards the principal of the loan. A mortgage insurance. Basically, mortgage insurance is for the home buyers that have is for the insurance comes to a hefty premium. It's to protect the lenders, not the borrowers. Basically, there's the private mortgage insurance companies, or if you have is let me put it this way: if you're first-time home buyer and you pay only 5% of the 5% down payment because of the house, then you would have to have a private mortgage insurance. Private mortgage insurance basically is to protect the lender, not the borrower. So basically, if this guy is buying a house and the mortgage company is XYZ, the private mortgage insurance will cover the XYZ company, not the person who borrowed it. If you're a first-time home buyer, there are programs available for the people who is the first time that wants to buy a house. One of them is the government backed loan. They can take advantage of offered by the private approved lenders, lower credit requirement, lower down payment, higher debt to income ratio, accepted, no income limited, loan limit, higher interest cost. Example, Federal Housing Administration is also FHA or USDA or others. The eligibility is for the credit score, debt to income ratio, and the steady employment for at least 2 years. Also, ladies, friends, I can tell you that that FHA loan it's backed by the government. It's the Federal Housing Administration. It's for the low to moderate income borrowers that has a low income with a higher level of debt. So for example, let's say if I want to buy a house, my income is not great, and then I have a lot of debt, then I can take advantage of FHA loan. And then also, if I have a lower credit score, and then if I can pay at least 3.5% a down payment of the house, and and then also you can only finance a primary resident. And then there's something else called conventional loan, is loans that backed by the government. It's for the lower income people that has a lower income, and then for those with a lower debt income ratio, excuse me, my apologies. That is for the people that have a lower debt income ratio, but they and also they have higher credit score, and they have also have a down payment, at least 3 to 20% down payment. And then you can refinance a primary residency, vocational home, rental property, and etc. The signs of a good mortgage. Well, basically, the sign of a really good mortgage is that you would have to think about the interest rate. The lower interest rate is a good thing. It's a good sign for a mortgage. If it is the fixed income rate, it's amazing, then you can go for it. Relatively low fees, being understandable, no penalties for paying early, no extra charges, no balloon payments, or also known as big payments at the end of the loan. So if any mortgages can do that for you guys, that is a very good sign of a loan, good mortgage. Get the right mortgage for your situation. So basically, the right mortgage, you have to think about for how many years you want to pay the loan, 15, 20, or 30 years. Then what kind of an interest rate do you need? A variable or a fixed interest rate, and then also the percentage of the interest rate as well. And then what will be your monthly cost? And the last question that you need to ask, all right, after I do this, can I afford it? And there's also Islamic mortgages also in the United States that you can think of. One of them is musharaka, is the co-ownership, is basically musharaka is basically you like buy a property with somebody else, and then also ijra is leasing to own. Basically, as another thing is just like you buy a house. Basically, you buy a house on a lease, and then also muharba is a resale with the deferred fee that you have to think about if you want an Islamic mortgage as well. You can also find lenders that can help you basically with mortgage, is national bank, such as Bank of America, Chase Bank, Wells Fargo. Those are the banks that can give you mortgages, and also local banks such as Credit Union or other banks, also local banks such as Zion Bank, Virginia National Bank, and etc. And believe it or not, there are also Federal Credit Union, such as Mountain America, Federal Credit Union, Bethpage Credit Union, and Align Federal Credit Union, and etc. And there's mortgage bankers such as Rocket Mortgage, PHH Mortgage, and a National Star Mortgage. And then mortgage brokers are the workers with money lenders to be able to find the best mortgage for you. That is the mortgage broker. Approval, pre-approval, and pre-qualifications. Pre-qualifications is basically an estimate of what a lender might lend a borrow based on just a discussion, no credit score or used for this. Pre-approval as lenders commit to lend borrowers a fixed amount of money based on the borrower's credit score and based financial information. And then the approval is the final full application process done, home appraisal done, and approval from the lender for a specific mortgage for a specific home is given based on a credit score and a fully understanding of a financial information. That is the approval, which is the very last step. Pre-qualification and then pre-approval. What are the differences between those two? The pre-qualification is provide a ballpark estimate of how much someone can borrow based on a data that borrowers submitted to a lender. Doesn't hold as much weight as the pre-approval, and then typically done for free over the phone or online. Doesn't include credit history report. And then the pre-approval, on the other hand, is slightly different. The pre-approval provides a definitive answer as to how much someone can borrow, as well as an interest rate. Speed up the buying process, requires the completion of a mortgage application and submission of various documents that will give the lender a clear picture of the borrower.